Today I'm going to be talking about round turn trade simulation in a function called txnsim, or txnsim if you like. It's a function I've been building with Brian Peterson. He's a market maker in Chicago, fairly well renowned R finance contributor. He's built many packages that are you'll find on CRAN. The package that we've built txnsim in is on GitHub. Again, that package is called blotter. So the topic of the talk today, which is round turn trade simulation, is also going to be a topic I'll be discussing at the R Finance conference in Chicago in June. The talk proposal, it's 19 pages. The PDF and the R Markdown are available at that link. So if you're interested in the topic, there's a whole lot more detail there that I can cover that I can cover in 5 minutes. So Brian lectures a master's course at the University of Washington, and this was an image that one of his students sent him, and I think it makes the point, right? So you have a back test, and it doesn't have to be a back test. It could be production trades. You have the results from production trades. And one of Brian's quotes, which clearly stuck with one of his students, was, "It's trivially easy to fool yourself into believing that you're brilliant." I think by being at satRday today, like, we're one step closer to being brilliant. But it is easy to fool oneself. Why be skeptical? Of course, you don't want to. I mean, this is a quote by Brian again. So you really want to be skeptical of your own results, lest you deploy money on a unsuccessful strategy. So what can you do? You have a back test, or you have a series of production trades. Well, one thing you can do is simulate those trades to kind of assess, was it skill, or was it luck, or was it potentially an overfit back test? One of the ways you can simulate is to simulate portfolio P&L, or which is something we've built in a function called txnsim. It's also in blotter. The info you get from simulating portfolio P&L is a little limited. One of the benefits, and it's well documented, is to look at the different measures of maximum drawdown from your replicates. So there's an example of an output from txnsim. It's not the topic of today, but it's in the field of simulation, and it sort of predates what we were doing in txnsim. In this case, this is the results from a backtest long trend, the long trend demo in blotter. You can see the distribution of maximum drawdowns from the replicates. You can see the confidence intervals by the blue dotted lines, and then you can see the backtest maximum drawdown. So it's kind of above the 95th percentile. The long trend demo, or the strategy, is a trend following strategy. For more details, you can refer to the demo in blotter. Simulating round turn trades is what we attempt to do in txnsim. The link is there if you want to view the source code on GitHub. Something that we try and do in txnsim is we look at the stylized facts of the strategy. So basically, percent time in or out the market, the ratio of duration that you're long or short in your strategy, and then also the number of levels or layers entered into. Of course, you want to limit that by the maximum position observed in the backtest or in the production strategy. One thing you'll have to do is define what you mean by round turn trade. So there's 3 definitions. You can use flat to flat, flat to reduced, or increased to reduced. Flat to flat are useful for trades where you enter one position and then close it. Generally, strategies are not that simple, so you'll likely refer to increased to reduced. You can pass those as arguments to the function. That's an output of the long trend demo to give you an idea of the flat to flat. On the blue bar chart, there's it's the position fill, so you can get an idea. That's B-band, so a lot busier. You can see there's layering, so you're entering multiple positions before you're closing out. This is the plot, the transaction sim plot for long trend. You can see that the strategy in the red line kind of does really well compared to its replicates, its random replicates. This is a plot of the same long trend demo, but just using txnsim, so you're simulating daily portfolio P&L. This is B-bands using transaction sim. Obviously, compared to long trend, it fares much worse compared to its random cousins. Future work, we want to add simulation methodologies, so CSCV per Bailey and Lopez de Prado, combinatorially, symmetric, cross-validation, a bunch of other simulation methods, and adding configurability and also optimization. Conclusion is we believe that transaction sim is a significant contribution for any analyst seeking to question the skill of, seeking to answer or evaluate the question of skill versus luck or overfitting from an observed series of trades. And some resources, if you're interested, I've left out White's reality check, which is a pretty useful one, but more for overfitting. And thanks.